Welcome back to another edition of Special Situations Investing with Greg. This week I'm going to be talking about a different special situation than I have talked about previously on this channel, and that is participating in post-bankruptcy transactions. Check it out. Hey everyone, welcome back to another edition of my YouTube channel on Special Situations Investing and my personal investing practice. As a quick disclaimer, this video is for educational purposes only. Any companies that I mention in this presentation are discussed solely for illustrative purposes. Discussing such companies and the specifics about them is to help educate me and educate you about certain special situations. It is not a solicitation to purchase them. I recommend that you conduct your own research and identify why you might want to own the company yourself prior to your committing of any funds. I also recommend that you seek the services of a financial advisor that has considered your personal situation as your fiduciary. And then finally, may your education here grow your knowledge, improve your personal investing performance, and give you the confidence to take control of your future. Thanks a bunch for watching. Now on to the video. Awesome. This week we'll talk about a post-bankruptcy transaction from Garrett Motion. But before we get into that, I'd like to spend a little bit of time talking about what to look for when we look at post-bankruptcy transactions. In his book, You Can Be a Stock Market Genius, Joel Greenblatt says the following: most investors should stick to the few companies coming out of bankruptcy that have the attributes of a good business, companies with a strong market niche, brand name, franchise, or industry position. After all, it makes eminent sense to apply Buffett's investment concepts to a group of orphan stocks not closely followed by Wall Street. Most of the time, a bankruptcy is filed because a company fails to meet their interest payments, or they are unable to roll over their debt and refinance it. This is the primary reason why a company would go into bankruptcy. And most of the time when a company goes into bankruptcy for those reasons, it is basically just a bad business, and sometimes they will emerge from bankruptcy, sometimes they won't. But in reality, the reason why they went into bankruptcy is because they're in a bad business and they got over leveraged. I want to avoid investing in companies like that. And in that case, you have to identify whether or not the bankruptcy has another reason for why it existed. And in this case, with Garrett Motion, it was because of a contingent liability. Now, this contingent liability was born out of Garrett Motion's spinoff. So Garrett Motion was a company that was spun out of Honeywell in 2018. And it was saddled with the contingent liability from Honeywell's past asbestos liabilities from its brake business that became defunct, most likely due to the asbestos liabilities in and of themselves. Garrett attempted to renegotiate its responsibilities under this asbestos liability with Honeywell. However, you should note that Garrett never needed, even with the higher costs involved, they never needed the liquidity and continued to post strong results, even as they went through the 2018 to 2020 automotive downturn. The asbestos responsibilities prior to the bankruptcy represented about $1.4 billion, and it was to be paid over several years. It also had several contingencies that allowed Honeywell to basically be in the driver's seat for many of the decisions that were made by Garrett's leadership. Post-bankruptcy, Garrett's responsibility to Honeywell was reduced from that $1.4 billion down to $584 million, and it released Garrett from any further Honeywell claims when paid off. Post-bankruptcy, Garrett also has a very complex capital structure. Along with the normal debt and equity, the company also collected two preferred share issuances. The first of these preferred share issuances is that given to Honeywell. Honeywell's preferred B interests are basically what Garrett owes in relation to the asbestos liability. Honeywell can redeem these in full at any time after Garrett's EBITDA exceeds $600 million for two consecutive quarters over the prior trailing 12 months. Some estimates indicate that that may be something that will be accomplished just by the latter half of this year. So it may be something that would be interesting to observe, and once that's knocked off, it should help improve the balance sheet, and not only improve the balance sheet, but also clean up some of the equity, the weird equity that's in there. The other shares that were issued were preferred A shares, and these represent about 250 million shares, and they have a strike price, a convertible preferred strike price into common at $5.25 per share. Now, the conversion price will automatically be exercised in 2 years if the trailing 12 months EBITDA exceeds that 600 million again, and the share price for the company's common exceeds the strike price plus 50%. So that strike price plus 50% is $7.88 per share. So the looming questions that I have looking at Garrett is, first and foremost, is it a good business? And does it have those good business characteristics? And more importantly, is it mispriced according to that? The good business tests from Greenblatt go back to that original quote, and they include that the company has a strong market niche, it has a brand name that is readily recognized in the industry, franchise, or the ability to have some sort of pricing power, and then finally an industry position of dominance. Speaking of the strong market niche, the turbocharger niche has become and will continue to drive Garrett's sales as automobiles have higher emission standards. Turbochargers allow an engine to increase its efficiency and thus meet these emission standards more readily. With the rise of battery electric vehicles, auto manufacturers will also be able to meet emission standards. However, I personally don't think that this will adversely affect Garrett's business until the latter half of this decade, 2026 or beyond. This transaction and Garrett's valuation mismatch should be done sometime in 2023. The brand name. Garrett's brand name and turbos are recognized as some of the best turbos in the industry by Motor Trend and other leading industry magazines. Is it a franchise? Garrett and its primary competitor, BorgWarner, maintain a duopoly position in their industry. In the late 2000s, Bosch and Mahle, two of the largest original equipment manufacturers, attempted to enter Garrett's and BorgWarner's market for turbochargers. After a decade of trying and hundreds of millions of investment capital, Bosch and Mahle were unable to crack into this duopoly's control of the turbo market. These turbos are typically designed into a car's engine cavity, and they're typically made as part of the car's manufacturing. More so as auto manufacturers have to meet some of these emissions requirements. And therefore, the design has several years in the making and allows Garrett extreme visibility into where it should be over the years. Most notably, you should look at, if you want to do some research on Garrett itself, they did finish their Wuhan plant, and if you think about it, a lot of their plants are connected almost in conjunction with the auto manufacturer that they serve, making it so that it's that much more valuable for them to be there. Once they've kind of established that spot, they become that franchise, and they always have that position in the company. It's like the company or the auto manufacturer can't take them out necessarily, or their switching costs are really hard because they're unable to move into a different turbocharger because it's not connected in conjunction with the manufacturer itself. Finally, the industry position. Garrett maintains its position as the largest turbocharger manufacturer in the world. In my analysis of a good business, I like to look for companies that maintain a high return on tangible capital. I calculate this by taking the earnings before interest and taxes and divide it by the sum of the net current assets and net fixed assets. So in order to get my net current assets, I take the cash plus the current assets minus the current liabilities, and then I add in the next net fixed assets on the company. A good business will get at least 20% from this calculation. I personally look for companies that have at least double digits in this area, and over the past 5 years, Garrett's return on tangible capital was ranged between 40 and 400%, with an average somewhere around 150 for this calculation. Now, in my view, anything over 20% is a good business, and Garrett is definitely exceeding expectations in that area. Now, to determine Garrett's stock price. For a good business like Garrett, a good price would have an enterprise value somewhere around 10 times its earnings before interest and taxes. In my due diligence, I calculated BorgWarner's price in relation to its enterprise value, and I came up with its enterprise value of 9.75 times EBIT. When looking at Garrett, I calculate that the current enterprise value is somewhere around 4.9 times EBIT. This tells me that investors purchasing Garrett at this time right now are getting $1 for 50 cents at a share price of around $7 per share. Well, how am I playing this? I am playing this by purchasing shares of Garrett preferred shares. So the GTX, it's traded under ticker symbol GTXAP. And this is in anticipation that the company will pay off its B preferreds to Honeywell in the next 12 months. I expect that Garrett should trade somewhere around $15 per share in the next 2 years. My exposure to this position is about 10% of my overall portfolio. However, I do have an additional way that I'm playing this, and I have about 1 to 2% of my portfolio dedicated to options trades on this, and I've purchased about 1% of my portfolio in options on Garrett Common. Now, these are long-term options at the strike prices of 7.5, 10, and 12.5. And I priced in, I wanted to purchase at a price where I think that if indeed Garrett does reach that $15 per share range, it should be that the company will, or my investment in those options should represent about a 5 or 4 times return on the purchase price. So just kind of giving you an idea of how I am playing it. Finally, there are risks that are involved with this. There could be another downturn in the automotive industry, and if there is, definitely that would adversely affect Garrett's operating results. I think Garrett's performance over the 2018 to 2020 automotive downturn was a good way to identify how the company will probably perform, which means that even at that rate, they'll still be doing okay, and they shouldn't have any solvency issues. They should be able to make the money necessary to continue to operate, and in the years following, be able to ramp up operations. The other risk that comes to mind is that the turbocharger business will remain flat due to the electric vehicle penetration. So when I think about this one, I do think that is a legitimate risk. My personal expectation is that electric vehicles, they don't represent as big of a portion of the market at this time. I know a lot of people are all excited about Tesla and stuff like that, but in reality, I just don't think that they're going to penetrate the market significantly enough to make a big difference on Garrett's turbocharger market. And with that in mind, the turbos themselves have to be added to a lot of the internal combustion engines that still are on the market in order for car or auto manufacturers to maintain their compliance with requirements for emissions standards. Anyway, guys, I hope you appreciated this analysis. If you have any questions, concerns, complaints, please go ahead and post them in the comments below. And I really appreciate your supporting me and subscribing and liking these videos. We'll catch you next week. Thanks a bunch.